Imagine you owned a rental property and you're walking around with $50,000 of tax savings just sitting right there under your nose and you didn't even know it. That sort of thing happens all the time. So today, I'm going to tell you about my buddy Greg. He's a real estate investor who almost made a $50,000 mistake. We're going to break down how you can avoid this even if your accountant has never brought it up before. Plus, I'm going to show you why you don't even need to change or renovate any of your properties to unlock this savings. This is probably the single most overlooked tax strategy in real estate investing. I go to these real estate conferences and I've seen it time after time with new investors, experienced investors, and even people who've owned rental properties for decades. They're all leaving money on the table. And then the crazy part is most CPAs and tax professionals don't tell their clients about this. And no, it's not like they're trying to hide anything. They just aren't trained or able to think strategically about real estate. So let's get into it. A few months ago, my real estate friend Greg, he hits me up. He's a super nice guy, owns a couple properties, and he's always looking to grow. Now, he's been watching this channel for years, so he says to me, Rich, my accountant says I'm doing everything right, but I still owe way more than I thought in taxes. He asked me, what am I missing here? So I just say, Greg, tell me about your situation. What do you got going on? So he starts telling me about this rental property that he bought 2 years ago. Paid around $500,000 for it. It's a real solid deal, beautiful building in a growing neighborhood. And when he told me the numbers, I knew immediately that there was savings hiding right there. I'll show you exactly what I spotted. Greg, he had been doing what 95% of real estate investors do, just taking standard depreciation, probably because his accountant told him to when he first got into real estate. And I mean, why would he question his CPA, right? He figured that was all there was to it, just standard depreciation. Now, what that really means is if it's a residential property, you spread it out over 27 and a half years, and if it's commercial, you spread it over 39 years. And that's the costly assumption and mistake that Greg's making. But it wasn't his fault. It's what he's been taught. It's what his accountant did for him. So for his situation, let's try to fix this because the payoff, when you do it right, can be massive. So most real estate investors do that straight line, regular depreciation. You buy a property, essentially chop it up over the years, and you get a tiny deduction every single year for decades. That's what Greg's accountant told him to do. But what he didn't tell him is that you can reclassify parts of the building. Instead of saying, one building, 27 and a half years, you can break it into buckets like appliances, flooring, lighting, land improvements, stuff that wears out way faster. And some of it you can depreciate over 5 years, 7 years, 15 years. This is called cost segregation. And it's perfectly legal. The IRS has accepted this method for decades. In fact, large commercial real estate companies and wealthy investors, they've been using this strategy forever. But for some reason, the average investor with, let's say, only a handful of properties never hears about it. It's like there's this secret tax playbook that only the big players get to use. But not anymore, because I'm breaking it down for you right now. When I told Greg this, he was shocked. He said, I don't have to renovate anything. I just told him, nope. You're not going to change the building at all. You're just reclassifying the stuff that's already there. The property stays exactly the same. So I said to him, think about it like this. Your rental property isn't just one big thing. It's actually made up of dozens of components that all wear out at different rates. And the IRS knows this. That's why they allow different depreciation schedules for different types of items. Carpeting, 5 years. Cabinets, 5 years. Electrical system, 7 years. Sidewalks, landscaping, 15 years. You unlock massive deductions now, not decades later. And yes, this works for properties you already own. It's not just for new purchases. You can do a cost segregation study on a property you've owned for years and still capture those accelerated deductions. And once you see how much money was essentially just sitting there, you're going to probably wonder why no one told you this sooner. So, want to guess how many hidden deductions Greg locked inside that one property? Just take a guess, because most people way underestimate it. All right, here's how we actually break it down. Greg's $500K property, after removing the land value, let's call it $450K for the building itself. In a bona fide cost seg study, around 20 to 30% of that value can be reclassified to shorter life deductions. Let's go conservative and say 25%, okay? 450K times 25%, that's $112,500. That means Greg could take that $112,500 of extra depreciation in the first few years. Depending on his tax bracket, that could mean around $50,000 in actual tax savings. That's real money back in his pocket that he could use to buy another property or invest in something else. And this isn't some theoretical concept or gimmick. This is straight from IRS code. It's the same strategy that big developers and real estate funds have been using for decades. You should have seen Greg's face when I told him. His jaw dropped and he says, "Why the heck didn't my accountant tell me this?" And I just shook my head. I'm like, dude, most accountants are focused on compliance, not strategy. They're checking boxes, not digging for savings. They want to make sure you don't get in trouble. They're not there to maximize your wealth. I mean, it's the difference between playing not to lose versus playing to win. Good accountants make sure you don't make mistakes. Great accountants help you find opportunities. So now Greg, he's doing cost seg studies on all his properties. Growing fast, paying less in taxes, using those savings to invest more for his future. I'm happy for him. And that's exactly why I'm making this video, because once you know this strategy, you can't unknow it. Here's the thing. You don't need to be some real estate tycoon. If you own rental property, whether it's single family, multifamily, commercial, warehouses, whatever, a cost segregation study could save you thousands, maybe tens of thousands. And no, you don't have to swing a hammer or redo kitchens. You don't have to change anything about the property at all. You just have to reclassify what you already own. But you want a legit cost seg study done. Has to be with professionals who understand the IRS rules and can defend it if you're ever questioned or audited. These studies themselves range in cost from thousands of dollars to a success-based fee that comes out of and is based on the amount of the tax savings found for your properties. And those tax savings can be 5 to 10x what any of the fees might be for those studies. So that's why this is so powerful. Yeah, there's a cost, but the ROI is unbeatable. I actually saw Greg last month, and you know what he told me? He says, "Rich, that cost seg study saved me $47,000 in taxes this year." And I just smiled and gave him a little fist bump. That's what happens when you start implementing advanced strategies like cost segregation. You begin to create a compounding effect. The tax savings from one property can be the down payment for the next property. Now you've got 2 properties throwing off cash flow, and then those savings help you buy a third, and on and on. It's like having a hidden growth accelerator that's been sitting right under your nose the whole time. I know some of you might be thinking, this sounds too good to be true, or there must be a catch. But remember, this isn't a loophole or gray area. The IRS has specifically outline these rules in their tax code. Think about it this way. When you buy a car, you don't depreciate it over 27.5 years, right? That'd be ridiculous. We all know cars don't last that long. That same principle applies to the components within your rental properties. One important tip, make sure you save your cost segregation study and then all the supporting documentation. Again, if you're ever questioned or audited, you'll want to show that your reclassifications were done by a professional and according to all IRS guidelines. And here's something most people don't realize. Cost segregation works with bonus depreciation rules also at the time of this recording. So potentially that allows you to deduct 100% of certain components in the first year. And that means even more tax savings to reinvest in your next property. It's like the government is literally helping fund your real estate empire. If you want to learn more about cost segregation, then I'll leave a link down below in the description of this video to help get you on the right path. So I invite you to check it out, because every dollar you save is another step towards financial freedom. All right, as always, I'm Rich, and until next time.